Picture this. The night is alive with neon. The air hums with electricity. Voices echo across marble floors, and 1,000 chips clatter as they fall onto green velvet. A casino. Everywhere you look, smiling dealers wave you in. The rules are simple. Play long enough and you'll win. At least that's what they tell you. But there's a truth whispered between the walls. The house always wins. Now imagine the same casino, except you can't see the slot machines or the blackjack tables. Instead, the neon is replaced by trading screens, glowing charts, and slick YouTube thumbnails. The dealers are no longer in tuxedos. They're 20-something influencers, standing in front of Lamborghinis, whispering the same line again and again. Just follow my signals and you'll never lose again. That's the casino you never saw. Welcome to Trading Psychology Stick, where we decode the mental game behind every trade. Before we dive deeper, remember, this isn't financial advice. It's psychological education. What you do with these insights is your choice alone. Let's make this concrete. In 2019, researchers studied thousands of day traders in Brazil. The results were brutal. 97% lost money. Only 1% could survive long enough to make even the wage of a taxi driver. Yet day after day, new recruits joined the game. Why? Because the dream of becoming a trader was too intoxicating. One trader from that study shared his story after losing everything in 6 months. He said something that still haunts me. I knew the odds were bad, but I thought I'd be in the 1%. I thought I was different. That single sentence captures the heart of the trap. Psychologists call it the illusion of superiority. You think because you clicked the button, you had power. You think because you studied charts, you had certainty. But the truth, the market didn't even know your name. What most people don't realize is this. Trading gurus don't need to be right. They just need you to keep playing. In a real casino, the dealer makes money from the statistical edge built into every game. In the Trading Guru casino, they make money from subscriptions, course sales, mentorships. They profit whether you win or lose. Just like the blinking lights of a slot machine, their social media feeds are designed to keep your dopamine firing. Screenshots of 100% profit trades, clips of easy money, testimonials that may or may not be real. Here's what cuts deepest. You are not playing a fair game. You think you're betting against the market, but the real bet is against your own psychology. The guru understands one thing better than you do. Hope is more profitable than truth. That's why the promises are so irresistible. They don't sell you systems. They sell you emotions. So, let me ask you this. Have you ever wondered why you believe them, even when the math makes no sense? Have you ever caught yourself thinking, maybe this one really is different? That's the moment you're not trading anymore. You're gambling. And if this feels uncomfortably familiar, good. Because the first step to walking out of a casino is to see that you're already in one. The next step is to understand the illusion that keeps you seated at the table. And that's what we'll uncover in Chapter 2. The math illusion. The guru's voice is smooth, confident, almost hypnotic. He says, I make 2% a day, every day. To the untrained ear, it sounds modest, almost humble, just 2%. Less than the tips you leave at a diner. But here's where the illusion begins. 2% a day is not 2% a day. It's compounding. And compounding, when weaponized by lies, becomes the deadliest illusion in finance. Let's slow down and run the numbers. If you start with $1,000 and make 2% a day, in just a year you don't have $12,000. You have over $1 million. In 5 years, you're sitting on more than $4 billion. Billion with a B. Richer than Soros, richer than Buffett, richer than Bezos in his first decade. So here's the million-dollar question. If this math actually worked, why would anyone sell you the secret for $2,000? Why not just hire a private chef, buy a jet, and disappear into the Maldives? The answer, of course, is that the math is the trick. It's the flashing light on the slot machine, the promise that the next spin is guaranteed. Because humans are wired to be seduced by exponential growth. We dream in straight lines, but the graph they show us bends into the heavens. And in that curve, we see our way out of debt, out of mediocrity, out of a life we secretly resent. Consider what happened with Bernie Madoff's scheme. For years, he promised steady returns of 10 to 12% annually, far more believable than 2% daily, yet still mathematically impossible to sustain forever. Sophisticated investors, hedge funds, even Nobel laureates fell for it. Why? Because the illusion of consistent returns overrides logical thinking when wrapped in authority and social proof. Here's an uncomfortable exercise. Calculate what happens if you lose 2% a day instead. In just 50 days, you're down 63%. In 100 days, you have only 13% left. The same math that promises heaven delivers hell with equal efficiency. But gurus never show you that graph. The truth that real investors understand: compounding is powerful precisely because it's slow. Warren Buffett didn't become a billionaire in 5 years. He became one because he averaged 20% annually for 50 years. He called compounding the eighth wonder of the world, but only if you survive long enough for it to work. The gurus twist that truth, dangle the fantasy, and feed on the very impatience that destroys traders. Now pause and feel this in your bones. Have you ever been tempted by that fantasy curve? Have you stared at a calculator, done the math in your head, and whispered, "If I can just make this much every day, I'll be free"? That's not ambition talking. That's the casino's voice in your head. But the math illusion is just the bait. Once you've swallowed it, they move to the hook. The psychology of why you keep believing, even after you lose. And that takes us into the darker chambers of the casino. Chapter 3, the psychology trap. The most dangerous trap isn't the chart, or the promise, or even the math. It's the one inside your own head. The guru doesn't just sell you signals, he sells you a new identity. From the moment you join his group, you're no longer a struggling office worker, no longer a tired student, no longer someone living paycheck to paycheck. You're a trader. Imagine stepping into a casino for the first time. The lights blind you, the sound of chips makes your pulse quicken. You win your first hand of blackjack, and suddenly the dealer leans in and says, "You've got a knack for this. You belong here." That's the psychology trap. Once you believe you belong, you stop asking whether the game is fair. You stop asking whether the math even works. You just keep playing. Ellen Langer's brilliant psychology experiment revealed this perfectly. She gave people lottery tickets, some self-selected, others randomly assigned. When offered the chance to sell their tickets later, those who had chosen their numbers demanded 5 times more money than those randomly assigned. The numbers were meaningless, the odds identical, but the illusion of control made them feel invested. Your hand-picked strategy works exactly the same way. Trading forums amplify this effect. Suddenly you're a part of a community. You share wins, commiserate over losses, speak the same language of support levels and resistance zones. The identity becomes social, harder to shed. When you lose, it's not just money. It's your membership card to this exclusive club that's at stake. Here's what behavioral economists discovered. Humans will risk far more to avoid losing their identity than to gain profit. That's why, when you lose, you don't walk away. You double down. Because admitting failure means admitting you're not who you thought you were. Let this sink in. Have you ever stayed in a trade you knew was bad, just because closing it meant admitting you were wrong? Have you ever paid for another course after the first one failed because quitting meant admitting you're not cut out for this? That's not persistence. That's identity protection. But here's the kicker. The gurus know this. They count on it. Every loss you take doesn't push you away. It pulls you deeper, because the only way to redeem the pain is to try again. The casino isn't built on winners. It's built on losers who keep playing. And if you think this is manipulative, wait until you see how they turn this psychology into pure theater, pumping markets, staging illusions, and cashing out before anyone notices. That's where we go next. Chapter 4. The Pump and Dump Circus. Chapter 4. The Pump and Dump Circus. The curtain rises, the spotlight hits, and the show begins. Except, this isn't Broadway. It's Telegram. It's Discord. It's Twitter. A guru's voice booms through the chat room. Buy now. Huge news incoming. This coin is about to explode. Within seconds, a flood of eager hands click buy, and the price spikes like fireworks. Screenshots fly, comments erupt. We're going to the moon. It feels like history in the making. But what you don't see is that the ringleader already sold his stake before you even finished pressing confirm. Welcome to the pump and dump circus. This is not new. In the 1920s, before the SEC existed, stock pools would accumulate shares quietly, spread rumors through newspapers, then dump everything on retail investors who bought the hype. Jesse Livermore himself participated in these pools. The only thing that's changed is the speed and the medium. Instead of newspapers, we have social media. Instead of days, it happens in minutes. The mechanics are devastatingly simple. Step 1, accumulate quietly when no one's watching. Step 2, create a narrative, partnership announcement, technical breakout, anything that sounds plausible. Step 3, amplify through multiple channels, creating artificial urgency. Step 4, sell into the buying frenzy you created. Step 5, disappear or blame market conditions when it crashes. In 2021, we watched this play out with SafeMoon and countless other tokens. Influencers with millions of followers promoted these projects, showing their own investments and gains. What they didn't disclose were the tokens they received for free, or their early entry points, or their exit strategy timed perfectly with their promotional posts. When regulatory bodies finally caught up, the damage was done. Billions extracted from retail traders who thought they were early. Here's what makes this particularly cruel. Markets are not just numbers. They are theaters of belief. The gurus understand something vital. Price is not moved by truth, but by narrative. When the story is strong enough, the herd follows. And when the herd follows, liquidity floods in. That's when the insiders strike. The pump is bait. The dump is inevitable. And every rocket emoji you see online is part of the performance to keep you buying tickets to the show. Take a hard look at yourself. Have you ever felt that rush? That dizzying high of seeing green candles stack like skyscrapers? Have you ever ignored the voice in your head whispering, "This can't last," because the crowd was louder, more convincing? That's not weakness. That's your brain on dopamine, orchestrated by those who understand your psychology better than you do. The most insidious part? Even when victims are burned, many come back. Because the circus doesn't just promise money, it promises community, belonging, and the intoxicating possibility of being early to the next big thing. Hope is always rebranded, always resold. But the circus is only one act in this grand casino. The next is darker, quieter, more dangerous. The wolves who don't shout from Telegram groups, but whisper in boardrooms. The professionals who don't need to fake signals because they own the table itself. That's where we're going in Chapter 5, the institutional mirage. Chapter 5, the institutional mirage. You've seen the circus, the clowns juggling coins, the fireworks of pumps and dumps. But what if I told you the real game isn't happening under the big top at all? It's happening behind closed doors, in air-conditioned towers of glass, where men and women in tailored suits don't gamble on the wheel. They own the casino itself. Welcome to the institutional mirage. The retail trader imagines institutions as mythical beasts, hedge funds, investment banks, shadowy billionaires, monolithic entities with perfect foresight and infinite power. Gurus whisper, "Follow the smart money. The whales always win." And in a way, they're right. But the truth is murkier and far more dangerous. Institutions aren't playing the same game you are. They're writing the rules, shifting the odds, and selling you the illusion of fairness. Consider what happened on May 6, 2010. In 36 minutes, the Dow Jones plunged nearly 1,000 points, erasing $1 trillion in value, only to rebound just as quickly. They call it the flash crash. Retail traders screamed. Gurus blamed market manipulation. But investigations revealed something more disturbing, a cascade of algorithmic trading, where machines traded with machines at speeds incomprehensible to humans. While everyday traders watched their stops get triggered in the chaos, institutional desks were already positioned to profit from the volatility they helped create. Here's what you need to understand. Institutions don't need to be right about direction. They profit from movement itself. They are the house, collecting spreads, earning from fees, playing both sides while you sweat over red and green candles. The mirage is the belief that you're competing in the same arena. In reality, their servers sit inches from exchange data centers, executing trades in microseconds while your order is still traveling through the internet. Their edge isn't better analysis. It's infrastructure you can't access. Payment for order flow adds another layer. When you place a trade through your commission-free broker, that order often gets sold to market makers who can see the flow before it hits the market. They're not front-running in the illegal sense, but they're certainly not playing blind either. Your edge becomes their information. Let me paint you a picture you've probably lived. You enter a trade, and immediately it moves against you. You hit your stop, and suddenly the market reverses exactly where you exited. It feels personal, like someone is watching your screen. In a way they are, not you specifically, but the aggregate of retail traders like you. Your stops cluster at obvious levels, creating liquidity pools that algorithms hunt with precision. The cruelest part? Gurus often cloak themselves in institutional language. We trade like the banks, this is what hedge funds do, to sell you the dream of standing shoulder to shoulder with giants. But institutions don't sell signals. They sell products, leverage, and most profitably, hope. The real mirage is believing you're on their team when you're actually the product being traded. But if institutions are the wolves, then who are you? Are you just prey, condemned to be hunted forever? Or can you step out of the mirage and see the game for what it truly is? That question leads us into Chapter 6, the emotional pendulum. Chapter 6, the emotional pendulum. Trading is a pendulum swinging between two extremes, hope and fear. Back and forth, endlessly, with your account balance as the weight. Most traders think they're fighting the market, but they're really fighting this internal pendulum, and the more violently it swings, the more damage it does. Hope is the sweet poison that whispers when logic screams to exit. You're down 30% on a position. Every cell in your body knows you should cut it. Your rules say, cut it. But hope whispers, look, it's bouncing. This could be the reversal. Remember that time it came back? So you hold and hold, until that 30% becomes 60, then 90, then a margin call. Hope didn't save you. It destroyed you. Now, watch the pendulum swing the other way. Fear floods in, not loud like greed, but subtle, tightening your chest when profit appears. After 10 losses, you finally catch a good trade. The position is up 20%, trending beautifully. Your plan says hold for 50%, but fear whispers, take it now before it disappears. Your hand shakes as you click close position. You bank the 20%, relieved. Then you watch in agony as it runs to 100%, 200%, exactly as your analysis predicted. Fear didn't protect you, it robbed you. This is the mathematics of emotional trading. If you let hope run your losses but fear cut your profits, you need an impossible win rate to succeed. A trader who loses full amounts but only takes partial profits needs to win 67% of the time just to break even. The market rarely offers such generosity. The 2008 financial crisis created millions of these stories on both sides of the pendulum. Lehman Brothers employees held their company stock as it plummeted, hoping for a government rescue that never came. Meanwhile, those who sold everything near the bottom, paralyzed by fear, locked in massive losses just before the eventual recovery. Hope and fear, working in concert to destroy wealth. Here's what neuroscience reveals. Your amygdala, the brain's alarm system, responds to trading losses the same way it responds to physical threats. Your body literally cannot tell the difference between a position going red and a tiger jumping at you. This ancient wiring, perfect for survival on the savannah, becomes your worst enemy on the screen. But here's the profound realization. Hope and fear aren't actually about money. They're about identity. Hope clings because admitting the loss means admitting you were wrong. Fear cuts early because being wrong in public, even if that public is just you, feels unbearable. Every trade becomes a referendum on your worth. The professionals have a different relationship with this pendulum. They don't try to stop it. That's impossible. Instead, they shrink its arc. Smaller position sizes mean less emotional weight. Predetermined exits mean no negotiation with feelings. They've learned that the pendulum will swing regardless, so they build systems that function despite it, not because of it. Ask yourself honestly, which side of the pendulum causes you more damage? The hope that holds losers too long, or the fear that cuts winners too short? Most traders suffer from both, swinging wildly between extremes. Their accounts gradually ground down by the motion. The answer isn't to eliminate emotions. It's to acknowledge them without obeying them. When hope speaks, listen, then check your rules. When fear whispers, pause, then check your plan. The pendulum will swing, but you don't have to swing with it. Yet mastering the emotional pendulum is just the beginning. Next comes understanding the stages every trader passes through, from barely surviving to dangerously overconfident. That evolution and its hidden traps awaits in Chapter 7, the evolution arc. Chapter 7, the evolution arc. Every trader passes through 3 distinct stages, like a caterpillar becoming a butterfly, except most get stuck in the cocoon or emerge with broken wings. Understanding where you are in this evolution isn't just useful, it's essential for survival. Stage 1, the survivor. You've just discovered that the market can take everything. Your first blown account taught you fear. Now you trade small, scared, checking every position obsessively. You've learned the market can hurt you, but you haven't learned how to navigate it. You're playing not to lose rather than playing to win. This stage can last months or years. Many never leave it. Paul Tudor Jones once said that his first priority is capital preservation, his second priority is capital preservation, and his third priority is capital preservation. That sounds like survivor thinking, but there's a crucial difference. He preserves capital to deploy it strategically, not to hide from risk entirely. The survivor hides. Stage 2. The controller. You've survived long enough to see patterns, to develop systems, to believe you can master this game. You sit at your desk, hands hovering over the mouse, heart pounding. A chart flickers in front of you, candles forming, lines crossing, signals aligning. You feel powerful. You feel in control. You believe that by pressing buy or sell, you are commanding the market. But here's the cruel joke. The more control you think you have, the less you actually possess. You adjust indicators until they show perfect historical results. You draw trend lines that seem to predict every turn. You place stops at precise levels, certain you've found the perfect setup. But you're actually painting patterns on chaos, finding faces in clouds, creating meaning where randomness reigns. The wins stack up, your account grows, and suddenly you feel invincible. This is the most dangerous stage. After 3 winning trades, something shifts in your brain. The cautiousness that kept you safe evaporates. You increase position sizes because you're in the zone. You skip your checklist because you can feel the market. Long-term capital management lived this arc at institutional scale. Run by Nobel Prize winners, they became so confident in their models that they leveraged 40 to 1. Their formulas were elegant, their track record stellar. Then Russia defaulted on its debt, a scenario their confidence had deemed impossible. In 5 months, genius became rubble. But here's what most don't realize. These stages aren't linear, they're cyclical. A massive win sends you to stage 3. A crushing loss drops you back to stage 1. Most traders spend their entire careers bouncing between stages, never achieving the stability that creates long-term success. The secret 4th stage, conscious competence, is where real traders live. They've been through all 3 stages enough times to recognize them. They can feel when confidence is becoming arrogance and dial it back. They notice when fear is becoming paralysis and push through. They surf between the stages consciously, using each when appropriate. Think about where you are right now. Are you the scared survivor, trading tiny positions and jumping at shadows? Are you the controller, convinced your system has solved the market's mysteries? Are you the confident one, feeling invincible after a streak? Or can you see yourself cycling through all 3, sometimes in a single day? The evolution never really ends. Even traders with decades of experience still feel the pull of each stage. The difference is awareness. When you know which stage you're in, you can compensate for its weaknesses and leverage its strengths. But even understanding your evolution isn't enough if you don't recognize the slow killer that strikes regardless of what stage you're in. The gradual exhaustion that turns passion into prison. That's where we descend in Chapter 8, the burnout spiral. Chapter 8, the burnout spiral. Trading isn't just charts and numbers. It's the weight of constant vigilance, the drain of endless decisions, the slow erosion of watching every tick as if your life depends on it. Burnout doesn't announce itself with fanfare. It seeps in like carbon monoxide, odorless and invisible, until one day you realize you can't breathe anymore. It starts innocently. You wake up at 4 a.m. to catch the London Open. You tell yourself it's dedication. You skip lunch to watch the charts. You call it focus. You dream about candlesticks, wake up checking futures, fall asleep calculating position. Sizes. You call it passion. But passion without boundaries becomes poison. A study of professional traders found something disturbing. Those who spent more than 8 hours a day actively trading showed cognitive decline similar to severe sleep deprivation. Reaction times slowed, pattern recognition failed, and most critically, risk assessment deteriorated. They weren't getting better with more screen time. They were literally becoming worse traders. The spiral accelerates. Exhaustion makes you miss good setups, so you force bad ones. Forced trades lose, so you trade more to recover. More trading means more exhaustion, which means worse decisions, which means more losses. You're not trading anymore. You're drowning in slow motion. In Japan, they have a word, karoshi, death from overwork. Traders don't typically die at their desks, but watch their accounts die from the same cause. The exhausted mind can't distinguish between opportunity and mirage. Every movement looks like a signal when you're desperate for action. Every pause feels like missed profit when you're running on fumes. Here's what burnout really is. It's not caring about the process anymore, only the outcome. It's clicking by not because the setup is there, but because you need to feel productive. It's staring at charts not to learn, but to avoid the emptiness of stepping away. It's addiction masquerading as ambition. I knew a trader who installed a cot next to his desk. He called it efficiency. 6 months later, he'd lost his account, his relationships, and his health. The market was still there, unchanged. But he was destroyed. The screens didn't care about his sacrifice. The charts didn't reward his dedication. They just took what he offered, everything. The cruel irony? The market is infinite, but your mental capital is finite. Every decision depletes reserves that don't regenerate instantly. Professional poker players know this. That's why they limit sessions, take breaks, walk away when tilted. But traders, especially struggling ones, believe more screen time equals more opportunity. It doesn't. It equals more mistakes. Consider your worst trades. Were they made fresh at the beginning of a session or after hours of staring, forcing, hoping? Were they born from clarity or desperation? The market didn't change. Your capacity to read it did. The solution isn't to trade less. It's to engage strategically. Set hard limits, maximum hours per day, maximum trades per session, mandatory breaks between losses. Treat your attention like capital to be preserved, not spent recklessly. The market will be there tomorrow, but only if you are too. Here's what survivors know. Longevity beats intensity. The trader who shows up fresh for 5 years beats the one who burns out in 5 months. Protect your mental capital as fiercely as your financial capital. Both can go to zero, but only one can be earned back. Yet even after mastering the emotional pendulum, understanding your evolution, and avoiding burnout, traders face one more subtle enemy, the chaos itself, the random noise that they desperately try to transform into meaning. That's where we go next, in Chapter 9, Dancing with Randomness. Chapter 9, Dancing with Randomness. The market is a storm of numbers, a collision of millions of decisions happening simultaneously around the globe. Every second, someone's algorithm fires, someone's stop triggers, someone's margin calls. And from this chaos, your brain desperately tries to extract meaning, to find patterns, to create order. But here's the truth that shatters most traders. Much of what you see is just noise wearing the costume of signal. Take a perfectly random sequence, flip a coin 100 times, and chart it. You'll see trends, support levels, head and shoulders patterns. Your brain will scream that these patterns mean something. They don't. They're just randomness doing what randomness does, occasionally looking like order. Nassim Taleb, the philosopher trader, built his career on this insight. He calls humans fooled by randomness because we're biologically programmed to find patterns. It's how our ancestors survived. The rustle in the grass might be wind, or it might be a predator. Better to see patterns that don't exist than miss ones that do. But in markets, this same wiring becomes our enemy. Researchers once showed people random charts mixed with real market data. Even professional traders couldn't reliably distinguish between them. The technical patterns appeared in both. The breakouts happened in both. The only difference? One had meaning behind it, the other was pure chance. It means much of what we attribute to skill is actually luck in disguise. That winning streak might be your edge manifesting, or it might be the market's random gift, soon to be randomly taken away. Here's the mind-bending part. Even random systems can have winning streaks. A trader who buys every Monday and sells every Friday will sometimes have months of profits. Not because Monday-Friday has edge, but because randomness occasionally aligns with any pattern. The danger comes when we mistake this alignment for truth. Professional traders don't try to eliminate randomness. They account for it. They know that even a 60% edge means 40% of the time. They'll be wrong for no reason other than probability. They don't take it personally when randomness wins. They don't adjust their system after every loss. They play the long game where edges manifest over hundreds of trades, not dozens. The market gives feedback, but it's noisy feedback. You can do everything right and lose. You can do everything wrong and win. The cruelest teacher is one who randomly rewards bad behavior and randomly punishes good behavior. That's the market. Consider this. A coin flipped enough times will eventually show 10 heads in a row. If you started betting on heads after 5 in a row, thinking you'd found a pattern, you'd eventually be right. But you weren't smart. You were lucky. And luck, unlike edge, doesn't persist. Dancing with randomness means accepting that you're not conducting the orchestra. You're just trying to stay in rhythm with music that changes without warning. Sometimes you'll be perfectly in step. Sometimes you'll stumble. The dance continues either way. The traders who survive longest are those who respect randomness without fearing it. They position size for uncertainty. They diversify across time frames and strategies. They never bet everything on their ability to predict the next note in a random song. Yet even when traders accept randomness, there's still a deeper layer. The stories they tell themselves about what those random outcomes mean, and the masks they wear to protect themselves from the truth. That's where we venture in Chapter 10. The Identity Prison. Chapter 10. The Identity Prison. Every trader is trapped in a prison of their own making. The bars aren't made of steel, they're made of stories and masks. The story you tell yourself about the market becomes your reality. The mask you wear while trading becomes your identity. And when story and mask combine, they create a prison so complete that most traders never realize they're locked inside. Layer 1. The stories we tell. 2 traders watch the same breakout fail. Trader A thinks, the market is rigged. They're hunting stops. They're out to get retail traders like me. Trader B thinks, breakouts fail 30% of the time. This was one of them. Next. Same chart, same outcome, 2 different stories, 2 different futures. One spirals into paranoia and revenge trading. The other moves to the next setup unbothered. George Soros built his fortune understanding this. He called it reflexivity. The idea that market participants' beliefs about reality actually change reality. When enough people believe a currency will fall, their actions make it fall. The story becomes the truth. But here's what most miss. This works internally too. The story you tell yourself about your trading becomes your trading reality. It's layer 2, the masks we wear. Every time you open your trading platform, you put on a mask. Maybe it's the stone-cold professional who feels nothing. Maybe it's the guru in training who knows everything. Maybe it's the warrior trader ready for battle. But when the mask becomes your identity, you stop trading the market and start trading to protect the image. Jesse Livermore wore the mask of the boy plunger, the fearless prodigy who could move markets. When he won, the mask fit perfectly. When he lost, instead of adapting, he traded bigger, desperate to maintain the image. He made and lost fortunes multiple times, each collapse tied not to market conditions, but to defending an identity that the market didn't recognize. Layer 3. The prison we build. When story and mask combine, they create something inescapable. The story justifies the mask reinforces the story, and suddenly you're not a person who trades. You're a trader, and that identity becomes more important than profit, more important than risk management, more important than reality itself. The most dangerous prison is the one you don't know you're in. You think you're making strategic decisions, but you're really making identity decisions. Every trade becomes a referendum on who you are. Every loss threatens not just money, but selfhood. Every win confirms not just skill, but identity. Watch your language carefully. Do you say I am a trader or I trade? The first is identity, the second is activity. One imprisons, the other liberates. Do you say the market beat me or this trade didn't work? One makes it personal, the other keeps it professional. Here's the test. Can you take a loss without it affecting your self-worth? Can you miss an opportunity without questioning your competence? Can you have a winning streak without believing you're special? If not, you're not trading. You're defending an identity that the market doesn't acknowledge. Professional traders cultivate what I call identity fluidity. They can be analytical when planning, aggressive when entering, patient when holding, humble when wrong. They don't have a fixed trading identity. They have a flexible trading practice. They're not traders. They're people who happen to trade. The path out of the identity prison isn't adding more stories or better masks. It's seeing through both illusions. You're not your wins. You're not your losses. You're not your account balance. You're the consciousness observing all of it, learning from all of it, evolving through all of it. And this brings us to the deepest level of all. Beyond the noise, beyond the stories, beyond the masks, lies the one truth most traders never face: the self. Because in the end, trading is not about conquering the market. It's about discovering who you become while attempting it. That's where we complete our journey in Chapter 11, The Self Beyond the Trade. Chapter 11, The Self Beyond the Trade. Strip away the charts, silence the alerts, close the platforms. What remains? You. Not you the trader, not you the investor, not you the risk taker. Just you, the consciousness observing it all. The market was never your opponent. It was your mirror, reflecting back every aspect of your inner world with mathematical precision. Every trade you've ever taken was a conversation with yourself. The market asked, "Who are you?" And your actions answered. Can you hold through discomfort? Can you cut when it hurts? Can you stay disciplined when chaos surrounds you? Can you remain humble when winning? These aren't trading skills, they're life skills, magnified by money and compressed by time. Viktor Frankl, the Holocaust survivor and psychologist, wrote that between stimulus and response lies a space, and in that space lies our freedom. Trading expands that space, makes it visible, forces you to live in it. The market provides the stimulus, price moves, and you choose the response. But watch closely. Are you choosing, or are your patterns, fears, hopes, and masks choosing for you? The traders who survive long enough to thrive undergo a transformation. They stop trying to beat the market and start trying to understand themselves. They realize that every loss teaches them about their relationship with being wrong. Every win reveals their relationship with success. Every drawdown exposes their relationship with adversity. This is why most people quit trading. Not because it's hard to make money, but because it's hard to face yourself. The market strips away every comfortable lie, every excuse, every story you use to avoid reality. It shows you exactly who you are when pressure mounts, when dreams collapse, when opportunity knocks. But here's the liberation hidden in this confrontation. Once you see yourself clearly, you can change. Not the market, that's beyond your control, but yourself, your reactions, your patterns, your choices. The trader who stops fighting the market and starts refining themselves discovers something profound. The market becomes their teacher, not their enemy. Think about what trading has already taught you. Maybe it revealed your tendency to hold on to losing situations too long. Not just in markets, but in relationships, in jobs, in beliefs. Maybe it showed you how fear stops you from taking opportunities, not just in trading, but in life. Maybe it exposed your addiction to being right, your inability to accept small losses, your pattern of self-sabotage right before success. The real wealth isn't in the account, it's in who you become. The discipline you develop trading serves you everywhere. The emotional regulation you master helps in all relationships. The ability to accept loss without self-destruction transforms how you handle life's inevitable setbacks. The patience you cultivate waiting for setups teaches you to wait for the right moments in all areas. This is the secret successful traders rarely share. They didn't win because they found the perfect system. They won because trading forced them to evolve into someone capable of executing any reasonable system. The market didn't make them rich. It made them capable of creating richness. So here's the ultimate question. Are you using trading to escape yourself or to discover yourself? Are you seeking fortune or seeking growth? Because the market will give you exactly what you're truly looking for. If you're seeking quick riches, it will quickly teach you about greed. If you're seeking mastery, it will master you first, breaking down everything false until only truth remains. The journey doesn't end when you become profitable. That's when it truly begins. Because then, you face the final test. Can you handle success without losing the humility that got you there? Can you maintain discipline when you no longer need to? Can you remember that the market is still teaching, even when you think you've graduated? The market is not your enemy. It is your mirror, and mirrors only work when you dare to look. Chapter 12, The Trader's Compass. You've just traveled through 11 chapters, not of market mechanics, but of human truth. From the casino, you never saw to the self you're discovering. We've peeled back every layer of illusion that keeps 97% of traders trapped in cycles of hope and despair. Now, you stand at a crossroads. You can close this video and return to the charts, armed with the same strategies but blind to the psychology that truly drives your results. Or you can pause, breathe, and do something different. Tonight, before you place another trade, before you watch another tutorial, before you check another chart, I want you to try something that might change everything. Not a strategy, not a system, but a mirror exercise that successful traders discovered long before indicators existed. First, take out a piece of paper, not your phone, not your computer, actual paper, and write down the last 10 trades you took. Not the profits or losses, but the emotion that drove each decision: fear, greed, revenge, boredom, hope. Confidence? Be brutally honest. No one will see this but you. Next to each emotion, write what you were trying to prove or protect. Were you trying to prove you're smart? Protect your identity as a good trader? Prove you can recover losses? Protect yourself from missing out? This is your real trading system, the emotional program running beneath the surface. Now, here's where it gets interesting. Look at your list and find the pattern. Which emotion appears most? Which identity protection shows up repeatedly? This is your psychological edge, not in the positive sense, but in knowing exactly how you sabotage yourself. Because once you see it clearly, you can't unsee it. But awareness alone isn't enough. For the next 7 days, I challenge you to trade with radical honesty. Before every trade, write one sentence. I am taking this trade because I feel. If you can't complete that sentence with something other than the setup is there, don't take the trade. Because the setup is never just about the chart. It's about what you're feeling when you see it. After 7 days, you'll have data more valuable than any back test. You'll see how fear makes you exit early, how hope makes you hold too long, how confidence makes you size too big, how boredom makes you force trades that aren't there. This is your real edge, not in predicting the market, but in predicting yourself. Share one discovery below, not your profits, not your strategy, but one truth about yourself that trading has revealed. When you write it publicly, even anonymously, something shifts. The mask cracks, the story changes, and transformation becomes possible. Remember, the market doesn't care about your dreams, your systems, or your stories. It only responds to reality. And reality begins with seeing yourself clearly. The 97% fail not because they can't read charts, but because they won't read themselves. The 3% succeed because they realize the ultimate truth. You're not trading to beat the market. You're trading to become someone who doesn't need to beat anything. Someone who flows with probability, dances with randomness, and finds profit not through force, but through understanding. The casino never closes, the circus never ends, the institutions never sleep, but you can wake up. And when you do, trading transforms from gambling into growth, from hope into skill, from a mask into a mirror. This isn't about becoming a profitable trader. It's about becoming a person who trades profitably. There's a difference, and that difference is everything. Welcome to the 3%. Not because you've arrived, but because you finally started the real journey, the journey beyond the trade, into the trader you're becoming. The market will be there tomorrow. The question is, who will you be when you meet it?